January 23rd of last year, we had David Burrows, President and Chief Investment Strategist at Barometer Capital on the program. He brought with him then three top picks. You, sir, are up a combined 12.2%. Top pick number one, Evercore Partners. That's the one that's the laggard in the group. You're down about 17%. Do you still own it?
No, we don't. We don't. I mean, in our portfolios, we are active managers. If something works, we will stay with it. If the numbers keep getting better, if the price performs the way that it should, that's great. But we run stop losses on all of our positions. And for those that don't work out, and there's lots, we have that risk budget. If it hits our risk budget, we come out. And our view was M&A would be much more active this year, which it was. But the investment banks did sell off through the summer last year.
So when you see an equity fall, you need to determine whether or not it's company specific or sector specific.
You do, but at the end of the day, we in our business feel we can only afford to lose so much on an individual position. You know, the road to hell is paved with, you know, I'm smarter than the market. So we run stops on our positions, and to the extent that they don't work, we take little losses. We won't take big losses.
Top pick number two from this time last year, United Rentals, which is up more than 8.5% since your recommendation. What about this one? Do you still own this?
We have a small amount of United Rentals remaining. This was a position that was aimed at taking advantage of a little bit more capital spending and some commercial building in the U.S. U.S. economy has been leading the world in recovering. And the stocks behaved very well.
Quite a roller coaster ride for
yes,
the last little
right.
while, though. Top pick number three is Canadian National Railway. This is the big winner in the group, up more than 45%. The quarterly results are due out tomorrow, and CP Rail's numbers suggest they're sneaking up behind them pretty quickly.
Yeah, the rails, you know, have been a wonderful investment over the last few years. I would say that the risk to the story right now is slow down in the oil patch. CNR of any of the rails has more north-south traffic, Canada, U.S., and down into Mexico. And there's some interesting things going on. You know, you got to pick up in lumber, and in 2001-2, that was 20% of CNR's freight revenue. So there's some opportunity there, but probably there is some risk from energy.
But we also have that risk that Keystone XL is not going to get approved in the United States, or if it does, it's still way down the road.
Look, these rails benefit from low energy prices, a pickup in North American demand. I think that the U.S. economy is behaving extremely well, so we're comfortable owning the stock.
As we're talking about oil, what do you make of this talk of $40 crude?
I have to tell you, I can't tell you where oil is going, but what I will say is we have saved a lot of money by not trying to pick bottoms. When something comes out of favor and really gets hurt, very often there has to be some significant washout that takes place before it's over. I've yet to see a big bankruptcy. There will be some. There will be some sloppiness before this is over. We don't try and pick bottoms. I'd prefer to see things get turned, start to perform a little better before we put any money at risk.
So you're not expecting to see evidence of a turnaround in the space until the financial Darwinism separates?
Here's the issue. In the past, you drilled a hole, you had a 50% chance of success, you tied it into a pipeline, and 45 days later you're producing oil. With the technology that they use today, when they drill a hole, they get a 99% chance of success. They tie it into a pipe and they're producing 15 days later. So they drill 20 at a time. This is mass manufacturing. It's different than it was. So if you shut down new exploration, you can turn it back on very quickly. It's different than building a rig out in the ocean and having a 18-month lead time. So we think it's unlikely you're going to get a big snapback in price because this has all been driven by supply.
We can take a brief break. David Burrows is here from Barometer. We're taking your questions about North American large caps. We still have a line open at 1-855-326-6266. If you're shy about picking up the phone, you can email us. marketcall@bnn.ca is the address. My Twitter handle's up on the screen. We'll fire up the Twitter machine and see if you've got any questions at 140 characters at a time.